In the 19th and 20th century, businessman John D. Rockefeller gained almost total control of the oil business. At the height, the trust that controlled all the Rockefeller's companies was responsible for no less than 91% of all oil production in the United States, as well as 85% of all petroleum sales. The government eventually stepped in and broke up Standard Oil, the Rockefeller's oil company, splitting it into several smaller companies. Today, the surviving companies of this famous breakup include Exxon, Mobil, Chevron, Amoco, and several other smaller oil companies, which were eventually sold to Sunoco and BP. The point is this: those who believe breaking up a company is a bad thing for investors might not really understand what it means to an investor when a major company is broken up. Hi everyone, I hope you guys are having a great day. Thank you for joining me. So today I want to talk about Google. Google was hit with another antitrust lawsuit yesterday by a coalition of bipartisan attorney generals from 38 states. It sounds scary. I'm not going to lie. Having the entire force of the American justice system after you with a vengeance and for political reasons is a little worrisome. But in this video, I'm going to share with you a few reasons why I believe, based on my experience as an attorney, why investors should not yet freak out over these lawsuits and panic sell the stock. In fact, it might be an opportunity to buy. First, guys, if you enjoy my content, if you want me to continue producing content, getting better at it, please like, please subscribe. Let's try to get to 100 subscribers by the end of the week. I really, really appreciate it, and thank you so much. So this is the third major lawsuit brought against Google in the last 2 months. This one coming just a day after Texas Attorney General Ken Paxton filed his lawsuit against the company, specifically targeting its massive online advertising operation. The plaintiffs in this case seek to consolidate the lawsuits with the initial DOJ lawsuit filed in late October. Essentially, what consolidation means is that they're going to merge and they're going to be heard in court together. The lawsuit comes months after the U.S. House Judiciary's Antitrust Subcommittee released their 500-page report, which they believe presents a host of evidence showing the tech giants frequently engaged and continue to engage in anti-competitive behavior and practices. While shares of Google were not majorly hit by the news, only down about 1%, it doesn't mean investors or potential investors should not at least take a pause and analyze what this means for the company in the long term and the short term. So let's dig in. The lawsuit seeks essentially to restrain Google from unlawfully maintaining monopolies in the markets for general search service, search advertising, and general search text advertising in the United States through anti-competitive and exclusionary practices. There are a few allegations in the complaint that I want to talk about. The first is that, as in many other businesses, a general search engine needs to find an effective path to consumers for it to be successful. So over the last 10 years, internet searches on mobile devices have grown rapidly, essentially eclipsing searches on computers and making mobile devices the most important avenue for these search distributions in the US. For a search engine to be most effective, it needs to be the preset default general search engine for your phone or computer. As soon as you open it up, it needs to pop up. So that means that the most amount of people that are using the search engine as their default is the best for the company. The reason for this is that even where users can change the default, they rarely ever do. So once you lock them in and you have your search engine as their default, they're never going to change. So according to the lawsuit, for years Google has entered into exclusionary agreements and engaged in anti-competitive conduct to lock up distribution channels and block rivals. You might wonder how they do this. Google pays billions of dollars each year to distributors like popular device manufacturers Apple, LG, Samsung, also to major phone carriers like AT&T, T-Mobile, and Verizon, and also to browser developers like Mozilla, Firefox, Opera, and UC Web. Specifically, they pay this money to secure default status on their search engine on these platforms. So in many cases, they even specifically prohibit these companies from dealing with Google's competitors. So essentially, they're just locking up the market, or that's what the lawsuit alleges. So these exclusionary agreements cover just under 60% of all search queries. Nearly half the remaining queries are funneled through Google-owned and operated properties like Google's browser, Chrome. Accounting for all of that, Google basically controls 80% of search distribution channels, and as a result of the exclusionary agreements, they account for nearly 90% of all general search inquiries in the United States. Therefore, according to the lawsuit, Google has foreclosed competition from internet search. Competitors in internet search are denied vital distribution, scale, and product recognition, ensuring they have no real chance to challenge Google. Let's talk about advertising. In terms of advertising, the lawsuit alleges that Google uses consumer search queries and consumer information essentially to sell advertising. So advertisers therefore pay huge amounts of money to be on Google's search engine, which raises the barriers of entry for its rivals, particularly for small, innovative search companies that can't afford to pay the multi-billion-dollar entry fee. Google has made some preliminary remarks about the DOJ's lawsuit. For example, in a blog post responding to Thursday's lawsuit, Google expressed that competition is just one click away. The company also expressed concern that this lawsuit essentially seeks to redesign search in a way that would deprive Americans of helpful information and hurt businesses' ability to connect directly with customers. Here are some reasons, based on my own opinion, based on my own research, why I don't feel investors need to worry much about the pending lawsuits against Google. The first thing is time. These things take a really long time. So we know this specifically in this case because Judge Mehta said on Friday at a status hearing that both parties agree that the trial will start in September of 2023. That means, at least in the short term, that's good news for investors who don't have to worry about immediate structural change that could potentially hurt the company's value. Another reason why the lawsuit against Google shouldn't, in my opinion, be an immediate concern for the investor is because these things often settle. So if we look to Microsoft as an example, the company was left essentially untouched, only penalized with some fines. The lawsuit was eventually overturned on appeal. Another thing to consider is that it's not Google's first time being sued. They've been dealing with regulators for a very long time. They have very good lawyers. You know, it comes with the territory of having a first-class product and service. In 2011, for example, the FTC spent 2 years building a case against Google for favoring its own products in search results. That was the allegation. So Google argued that they provided customers with high quality and low-cost goods. You know, in the end, Google made some minor changes, made minor concessions, allowing online advertisers essentially to use rival websites to manage their campaign ads. And then 5 FTC commercials voted unanimously to drop the case. So according to many analysts, the current case against Google is essentially much of the same issues being relitigated. Regulators and lawmakers don't have free rein to break up companies. Politicians talk a big game, yes, but ultimately the judiciary, the judges, they are in charge. You know, they're guided by complex legal rationale, legal principles, and decades of precedent. They don't just have free rein, and they never do. They take their jobs very seriously. So it's not just, oh, the politician said it's going to be broken up, so it's broken up. Here's another reason why I don't believe that investors should worry. So let's say in the end, let's run through some scenarios. Let's say in the end, Google is prohibited from paying to have their search engine as the default and preferred search engine on these platforms. Because of their dominance in the market, it's likely that people will still resort to Google as their default search engine. It's just the best product. You're not going to start using Bing. Who uses Bing? Another thing that can happen if Google loses is the regulators might prohibit or make it a lot harder for them to acquire other companies. So in that case, a few things could happen. Either there's a way around that, and they could acquire companies in certain ways, or you have to assume that the core of what Google is now is what you get. But the good news is that's pretty damn good. So since it's a possibility, let's assume that the worst thing happens and Google is forced to be broken up. It's not necessarily the worst thing. People automatically think breaking up a company is the worst thing. Most of Alphabet's companies are run as independent companies already. They have their own chief executive, board of directors, and even the ability to raise outside investment. Some of these like Google and YouTube are extremely well known, valuable. They could be standalone public companies today if they wanted. Others such as Waymo, the self-driving cars, Google Cloud Computing, Google Ventures, Venture Capital, Verily, Life Sciences, Calico, Biotech Research and Development, Loon, Rural Broadband, and DeepMind, artificial intelligence. these are not companies that are quite there yet, but they're works in progress. They are growing and have huge room for growth in the future. So an investment in the shares today is like getting all of these parts for free, you know. Look, in terms of the immediate stock price, I think it is possible that, you know, investors already factored this into the stock. Think about it. Google has lagged the other FANG stocks by a pretty substantial margin this year. And you wonder whether the reason is that investors are pricing in the fear of the coming regulation or the potential regulation or lawsuits that are currently ongoing. So I guess all this is to suggest that Google is an incredible company with an incredible balance sheet. They have so much growth potential ahead of them in terms of their AI, their self-driving cars. There's, you know, so many other industries that they're tapping into. So antitrust lawsuit could be a hurdle that they have to overcome. You know, a lot of bad press. So maybe in the immediate term, a lot of volatility with the stock. But in terms of the company being an unworthy investment, I would personally suggest not. I'm personally an investor in Google. Again, you have to do what you feel comfortable with your money and do your own research. This is just my opinion. But I think that, you know, these lawsuits take a very long time. And ultimately, there's some very good lawyers that are working on behalf of Google who are likely going to settle this thing or at least make concessions so that there's no serious effect to the investor in the short, maybe not in the short term, but in the long term. So thank you so much for watching. I really appreciate it. Please like, please subscribe. Please comment below if you're interested in a specific topic. I'd love to do a deep dive into it. Thank you so much for watching and have a great day.